I'd like to think that we are the inflection point.
That's Mark Machin, the CEO of Opto Invest, a digital platform that connects investment advisors to highly sought-after private equity funds. Today on Dry Powder, Mark will explain why his company is pursuing certified RIAs with a laser-like focus.
The type of people who are going to click on their phone and buy an alternative product, probably much more concentrated on people who've got experience in finance. So we wanted to go after what we think is the much bigger addressable market.
If you haven't heard our episodes with the CEOs of Titan Bay and Moonfair, I highly recommend you go back and listen. We've included links to those conversations in the episode notes. I'm Hugh MacArthur, chairman of Bain's global private equity practice, and this is Dry Powder. Well, Mark, I'm sure this is going to be an incredibly exciting and informational episode, and I just wanted to begin by thank you very much for stopping by the show today.
Well, Hugh, it's my pleasure. Thank you for inviting me.
You know, when I think about retail investing, and when I say retail, I mean individual investors getting access to private capital, it really is a landscape that's been developing at a pace that frankly has astonished me over the last couple of years. 2 years ago, if you'd have asked me, well, how long is it going to be before individual investors are really going to get access to private markets, I would have said, oh, that's 5 or 7 years down the road. And even though there are a lot of things that still need to happen, it seems like there's a confluence of events going on that are quite intriguing in that retail investors want access to private capital. Their advisors now are telling them that they should want access to private capital because the public markets are becoming more thinly traded. And of course, the purveyors of private products are always looking for new funds. So it seems like there are lots of interested parties at every angle here that are trying to make this happen. So let's begin by talking a little bit about Opto Invest and that eye-opening Series A round that you recently did. How did you actually come out of stealth mode with $145 billion in funding?
Yeah, look, we were very pleased with the A round. We had terrific support from a lot of savvy investors. Of course, Tiger led the round. We had 8VC, ThinCap, Michael Dell's family office, and a long list of luminaries and funds across the financial services industry. So the support was tremendous. I think everybody saw that this is a massive channel. The independent part of it alone is somewhere around $8 to $10 trillion of assets, 19,000 firms. And the fact that RIAs are dramatically under-allocated and underexposed to alternatives, average client being in low single digits exposure to alternatives. So the addressable market is huge. And I think that investors shared our confidence that we could finally crack a lot of the barriers that have kept these RIA clients from investing in the past. They include access to information, confidence, access to quality funds, and surmounting all the operational complexity and alignment issues that have existed in this space before.
So, Mark, you decided to focus on RIAs exclusively.
Yeah.
What went into that decision? Was that always the game plan, or did you arrive after some trial and error? Talk to me about that unique way of going to market and that unique customer base that you're really targeting.
Yeah. So I say two things. One is for most people, if you haven't been in finance, if you haven't been in financial services, if you haven't been in investing or something related, call that, 90% of people, they're probably going to want guidance from a financial advisor when they're investing in alternatives. So we wanted to go after what we think is the much bigger addressable market. The second point would be, I think it's the one that's the most challenged. In the words of Silicon Valley, the most broken part of the ecosystem. And there's a lot of obvious barriers which we think we can surmount and help these advisors do a much better job for their end customers.
Now, Mark, as you said, these RIAs are dramatically underexposed to private asset classes, and they require some education as well, not having the experience level that some others may have that have worked in finance for a long period of time. How do you actually get an RIA up to speed on private equity so that they can actually recommend and help their clientele invest with confidence?
Yeah. So first of all, the education is the most important thing. The way that we bring the advisor along and the customer along is portfolio analytics. So we have the technology that's available for them to analyze their client portfolios, model them on the benefits of exposure to alternatives. So they can actually show what including private equity into the portfolio would do, show the risk and return characteristics, play with all the underlying assumptions. And then most importantly, they can share that with their customer, looking at what different exposures to alternatives would do. And then they can plan a tailored portfolio for their customer over multiple years, and again, share that with their customer and bring them along. So that portfolio analytics piece we think is really powerful. It's not just a theoretical or a bunch of adjectives. There's a bunch of numbers and illustrations as to what it is likely to do to your portfolio.
It sounds like a fascinating platform that you've developed. Are there some stubborn sticking points in the user journey that you found in educating these people? And I'll follow on quickly if I can with a second question, which is, what custom features or services have you developed to help people get unstuck?
Yeah, so I mean, the biggest sticking point is just inertia. A lot of advisors have stuck with 60-40 portfolios for their whole careers. So that's the biggest sticking point overall. Secondly, related to that is lack of comfort with the private investing world, the different nomenclature, the different language. And so we're trying to use the technology to provide the education, provide the analytics that can then help those advisors help their clients.
Okay, so Mark, once you've got an investment advisor excited, how do you decide which private equity funds to include on the platform? What sort of funds make the cut and what sort of funds don't make the cut?
Yeah, and I just say up front, so we're covering 5 sleeves. We're covering venture capital, private equity, real estate, infrastructure, and private credit. And so we have the same approach for all of these sleeves. Number one, we have an overarching commitment that we must have high conviction in the fund. And we're actually putting our money where our mouth is on that. We're actually using our own capital, which is one of the reasons why we did the large A round. We're using our own capital to back the commitments to each of those funds.
So you've got your own skin in the game in each one of these sleeves.
Yes, we have our own skin in the game. And in fact, the way that we get paid in the end is substantially from the performance of the funds in the future. So we're getting paid a smaller incremental piece of carry. And that's where substantially most of our economics come from. So we totally aligned with the RIA and their end client on those funds. If they don't perform, we don't get paid. So we do all of our own work analyzing performing funds. We have access to the best databases that are out there. We use external advisors as a second line of defense. And then we use our own networks, whether it's Joe Lonsdale's network within venture capital, or it's mine on networks within the asset owner world. In terms of the types of funds that we're bringing on the platform, we do have a mix of first-time funds from managers that people in our networks have worked with, worked opposite, negotiated deals on the same side or opposite sides of the table, participated on their boards, etc., and just seen a skill, an edge. And so we have those new managers both in venture capital and on our private credit sleeves right now. At the same time, we have traditional LBO type funds, people who've got 20-year track records, raising multiple funds. And we have a couple of sector specialists as well. We have one in software and one in financial services. So we're trying to do all of the pre-vetting that we possibly can of these funds before putting them on the platform.
So, Mark, if I can just paraphrase, I think some of the competitive advantages or potential competitive advantages you're describing here are first, the focused on RIAs, which is kind of what I call a hit them where they ain't strategy. There's no one really doing this in the way that you're doing it in the market right now, which gives you a first mover advantage. And secondly, I'm hearing that potentially your alignment of economic interests with the individual investors and the RIAs is also potentially differentiating in the marketplace. Are there other qualities or sources of competitive advantage that you think set Opto Invest apart?
Well, I think those two that you mentioned are really important. So focus and alignment. I said the third thing is the fresh technology that we're building here and quality of the technologists that we have, given Joe Lonsdale's pedigree. So that was one of the reasons that attracted me to partner with Joe on building this business. I had confidence. I knew the financial industry and was at Canada Pension Plan, CPPIB, for almost 10 years. And we had a massive pool of capital that we could allocate to any asset class or industry around the world. And from that perch, I was able to see what the best of private managers look like. But I'd not built a technology company before. Joe's got masses of experience in doing that. And he's had a passion for democratization of access to alternatives for many years using technology. He's built a number of adjacent companies. And I learned from Joe about how poorly served, underserved US wealth was in this space. And we felt together that we could build a first-class solution to tackle that, bringing together the best of insights into alternatives and into private investing and bringing together technologists.
Now, clearly, you've taken quite an avant-garde position here because, as you mentioned earlier, you're not just talking about forms of private equity, which include, of course, buyouts and venture capital, but you've moved into other private asset classes as well. You're representing real estate, credit, infrastructure, really a panoply, the whole menu, if you will, that an RIA might want to offer to their customers.
Yeah.
Do you think that we've reached some type of inflection point in this type of private investment platform development over the past year? Are we still in the very beginning stages? There's a lot of noise in the market and the media about it, but where are we, do you think, on this journey?
Yeah, look, well, I like to think that we are the inflection point. So, we're obviously seeing a lot of interest. I do think that last year, given the shocking underperformance of the traditional 60/40 portfolio, that really pushed many RIAs, many wealth managers who'd been reluctantly looking at the space to say, look, we've just got to take it seriously. We have to look at alternatives. That itself was an inflection point. And then secondly, from the GP's world, given how full up institutions, the traditional big allocators are, they've also had to look at the space much, much more seriously in the last 2 years. And one of the things that's held them back is it's fragmented. They don't want to deal with all the small investors. They don't want to deal even with the RIAs necessarily. So they've been looking for technology-driven solutions that make life very easy for them as well. So while we're very clear that our customer is the RIA, obviously the funds that we approach to say, we'd like to have you on our platform, it's a very easy conversation with all of them because more and more and more of them are looking at efficient ways of accessing this channel.
It does really seem like that combination of factors that you described are propelling the market forward in terms of attractiveness and interest in retail investment in private platforms. One of the things that I draw a cartoon about, it's not really a cartoon, it's just some factoids in the US market that kind of brings this to life, is that there are 21,000 companies in the United States that have at least $100 million in revenue. And less than 20% of those are public. So You're literally missing out on 80% of the economy if you're just investing in the public markets. And credit markets, as you well know, have been very unattractive, generally speaking, from a yield perspective over most of the last decade. That might be changing, but there are lots of different ways emerging to play those as well, including private. And your point about the 60/40 traditional model returning dismally last year, I think has spurred a lot of folks to rethink, where should I be investing? And in fact, when we do interviews and surveys of investment advisors, they tell us that the number one reason that they would be recommending alternatives to their customers and their clients is for diversification away from public. There are public assets that are more volatile now, more thinly traded now, and they still could be quite attractive in markets like the United States and internationally. But once you have enough of it, you have enough of it. And what else is there? It turns out there's a lot of the economy to invest in that is more than the S&P 500 and some of the available credit products today.
Yeah, I couldn't agree more, Hugh.
Now, we've talked about the educational programs you have for investment advisors, the technology, the tools for portfolio planning that you bring to the table. One of the other big barriers to getting individual investors more involved in private platforms is the regulatory landscape. How do you see that evolving over the next several years?
Two things. One is that there is general support for democratization of access from regulators. And then secondly, appropriately so, the regulations are highly disciplined on disclosures and transparency. I mean, one of the challenges for an average investor is the fees upon fees upon fees that you get in this space. And I think, we have absolute alignment. We're not taking fees or, from anyone else. We're not taking fees from GPs for, in the channel. We're singularly aligned with the end investor here. But I think that push, that discipline that's required on disclosure and on transparency is important.
That's fascinating. And actually, one observation I'd make on that is that it may be that through retail or individual investors getting access to private platforms, a lot of institutional investors will be getting a lot more information from their GPs than they have to date because of the protections that will be afforded to the individual investors. So there could be a double benefit to the entire industry, if you like, disclosure and transparency as a result of this increase in individual investment.
Yeah, that's quite possible. And, I had the privilege of sitting on a very big pool of money where we could get fantastic transparency, but not all institutional LPs benefited from that. And I'm always in favor of information and transparency.
Now, a couple of the other areas I wanted to get your wisdom on, Mark, challenges, I should say, are liquidity and valuation, which kind of go hand in hand. We're going to need mechanisms in any type of retail market to provide more liquidity than typically institutions are afforded. And obviously, these are illiquid asset classes, but things happen in individuals' lives. And so how do you think about providing liquidity, providing advice, and how do you think about what you educate one of your investment advisors about? How much of an allocation toward private illiquid asset classes an individual investor should have? How should they think about that? And how do you think about liquidity involved in all of that?
Yeah, it's a really important question because every investor is different. Every investor has different life pressures and requirements. And so I think it's really important for the advisor to work with each of their clients on that type of thinking. I mean, our advice is not to overdo it. Have a prudent amount of investment in private assets. Plan for those emergencies that might happen in the future. Make sure you factor that in. Having said all that, if something else happens over and above all of that, there's an increasing number of liquidity providers out there who will give you a decent price for your private investment. So there are firms like NASDAQ Private Markets, there's Liquidity, which is a firm we've spent some time with and quite like. And we refer our clients, if they end up in that type of unexpected distress situation, to one of these providers and help them get liquidity in that extreme situation.
So, Mark, as you think about the universe of RIAs, what do you consider the total addressable market for Opto Invest?
I think at the moment we are only addressing the QP market, so the qualified purchasers, so people who have over 5 million investable assets, et cetera. But we will be creating product for accredited investors as well going forwards. And when you look at what assets are managed by independent registered investment advisors that are under allocated to alternatives, it is in the trillions of dollars. So the market is huge. The potential there is huge. And the problem that we think needs addressing is still huge.
When you consider that half of all global wealth is in the hands of individuals, it really is a gigantic opportunity, particularly since only about 16% of all of the capital that's put into private markets comes from individuals today. So it is a huge opportunity. Totally agree. What would you say? We've had a lot of discussions here, Mark, about the opportunities and the incentives of retail investors and product providers from the alt side and distributors to get involved in this, and on this sort of confluence of factors, all having people interested in providing private capital platforms to individual investors. But what do you say to a listener who's still doubting whether or not retail capital is actually going to make a dent in the private markets?
I think it's already making a dent. There will be GPs out there who think that retail is expensive and operationally challenging to reach. And I think simply a GP only has to deal with us. They don't need to deal with the RIAs and the end clients. They have one interface, and we're committing capital up front as well here. So it's operationally straightforward for the GPs as well.
Absolutely understand. Well, Mark, I want to thank you for coming by and being on the show again and educating our listeners today, as well as me. Given your 30-year history in finance and given what you're doing now, which is really at the leading edge of the new opportunity for individuals to invest in private markets, it's been a fantastic opportunity for us to sit and chat and learn. And so thank you once again for stopping by.
Huge pleasure. Thank you, Hugh.
One last note. I've started a series of weekly posts on LinkedIn, and if you're interested, please follow me so you can receive these updates. I'm Hugh MacArthur. Thank you for listening.